Hello and welcome to FT Markets. I'm joined here today by Dan McCrum from FT Alphaville, and we're going to discuss what's likely to unfold next week for both equities and bonds as investors come back from their long weekends here in the UK and in the US and count down the last 4 trading days of the month of May. Dan, thanks for joining us.
Oh, thanks, Mike.
Let's take a look at this first chart, which I think is very, very interesting. It shows the monthly performance here of the S&P 500. Looking at this performance we're seeing so far during May, what is this telling us about the equity market, do you think?
Well, it's pretty easy to look at this chart and think the market is running out of confidence. We're seeing a lot of less confusion from investors, but more just real uncertainty creeping in about the assumptions they were making about economic growth, about earnings and how that's going to come through. And what we've had is we've had a very long and very good bull market for investors, which has largely been built on valuations.
Yes.
And we've been waiting for the earnings to come through and catch up. But in the US, we've had a first quarter where the GDP, weather-related and various things, not quite as good as we expected. And we've had a first quarter earnings season, which is pretty much finished now and is okay. But again, we're still not getting those big upgrades which people are looking for. And generally, people have not been making money, and they're starting to doubt what is happening and perhaps what is happening with the US economy.
Well, that's an interesting point you raised, because let's take a look at the second chart we have here. And this shows the US 10-year Treasury note yield. Now, as we can see, it's made a pronounced drop since it was flirting above 3% at the start of the year. This is the trade that has definitely confused a lot of investors. Why has the 10-year yield dropped so far?
I think, again, we're seeing inflation seep out of the global economy. We're not sure what's happening in Europe, whether Draghi is going to take truly unconventional measures to address inflation. And again, those fears about the US growth are creeping back in. And this idea that maybe rates are going to be lower in the long term than perhaps people had been expecting. And I don't think we're going to get the answer to this next week because, again, there just isn't that much data coming through and it's going to be light trading. But you're starting to worry, are rates ever going to go much higher? And in which case, 3% or anything close to that seems pretty attractive. And you're starting to see some buyers come back in for that.
Yes. The other interesting point of this, of course, is that if you look at the S&P 500, it is essentially just shy of record highs. And yet we've got a 10-year yield at very low levels. Is there this divergence? How long can this divergence be maintained, do you think, between these two key asset classes?
Well, it's almost like we're waiting for some sort of signal. And will the economy suddenly get better and justify everything that's been happening in stocks? Or are we waiting to see something worse, which perhaps the bond market is signaling? Or are we going to be in this sort of moderate, low volatility? There's this general feeling that everything is in a sort of steady state while the central banks are supporting markets. And there's no sort of resolution in either direction.
Great. So now in the near term, of course, we're likely to see next week some degree of window dressing, whereby it's likely, do you think, that bond investors who've missed the rally come in and buy more bonds, which will potentially push prices up and yields lower? And conversely, do you think people will continue to rotate throughout the S&P, the major sectors that dominate that market?
Yeah, if you're trailing a bond bogey with things are looking pretty tough for you this year. There aren't many investors who sort of bought into this latest rally. So do you chase that and try and catch up, or do you risk looking even worse at the second quarter? And in terms of stocks, I think we could very easily see some of this rotation again. You've already seen tech being hit quite badly. Might be normal to see some rotation back away from the cyclicals into some of the more defensive yield-like dividend names.
Certainly, because the utilities haven't had a good month, but they could actually maybe catch up a bit in the coming 4 days. Great, Dan. Well, on that note, I suppose we're going to be waiting and watching, because once we get through May, we've got the 2 key events in the first week of June, first being the ECB and whether they do take some dramatic action to push up inflation expectations in the Eurozone and also get that economy moving. And then finally, we'll get to see the US May payroll report released at the end of the first week of June, and that could potentially help settle what is quite a stunning divergence between what the bond market is telling us and what the equity market is currently doing in the US.